Hi, my name's Tom Elliott, Chief Investment Officer of Beulah Capital, and welcome to the first of our regular share market updates. First I'll have a look at what's happening generally in the stock market. Now of course we've had all sorts of significant events recently. The US election, Barack Obama did get elected for a second term, which in some ways is good, it means continuity. On the other hand, he's facing a big thing called the fiscal cliff, where a whole lot of tax cuts and spending increases that were enacted in the dying days of the Bush administration 4 years ago are coming to an end. Barack Obama's first and most urgent task is to negotiate with the Congress, which is still dominated by the Republicans, to try and extend those tax cuts and those spending increases. If he's unsuccessful, there's every chance the US economy will go back into recession. However, my feeling is that a deal will be done. It's just a question of will it be done before Christmas, or will they sort of extend the brinkmanship and go right through to around February 2013. Only time will tell. Of course, it does mean for volatile times in the stock market, the longer it takes to do such a deal. Of course, we've also had the Reserve Bank locally. It didn't cut rates in November, however, it did get them down to near global financial crisis lows in October. The official cash rate is currently 3.25%. And there's some signs in both the real estate and retail markets that the cheaper interest rates are starting to improve consumer confidence. Myer, for example, reported an uptick in its first quarter sales. We haven't seen that for quite some time. And finally, from a general perspective, we've seen the aftermath of Hurricane Sandy didn't have a massive impact directly on the Australian share market, unless of course you're unfortunate enough to be a shareholder in QBE. More on that later. Now of course, here at Beulah we've got quite a few different equity portfolios. I'm going to run through our three main ones at the moment. Firstly, our model equities portfolio. This is our large cap portfolio. It focuses on the top 200 stocks and tries to outperform that very index, the ASX 200 index. Now I mentioned QBE before. It was hit pretty hard post Hurricane Sandy. Now it's fair enough for insurance stocks to have exposure to weather events. I mean, that's the reason we have insurance. However, the company's admission after the hurricane that in fact quite a few of its losses were not related to Sandy, they were other things they found in the accounts, does give us cause for concern. Now, several months ago, we'd already heavily downweighted QBE in our portfolios from around 5% of funds under management down to 2%. In fact, we replaced it with Insurance Australia Group, which in hindsight has proved to be a very, very good move. IAG doesn't have any direct exposure to the US markets and has performed very well. I think another area that's worth looking at is the banks. They've had a fantastic run the past few months, but that came to an end when National Australia Bank had what really amounted to a profit warning. Now, NAB does have exposure to the troubled UK banking market. It would like to get out, but it can't. But the reality was, even leaving that aside, if you look at the profit reports of all the banks, ANZ and Westpac also reported, at best they're growing their operating profits 5–6%, which is not nearly as much as the double-digit increases we got used to in the past. I do think the banks will remain good dividend payers, but I think the era of easy profit growth is well and truly past, and as a result we've been slightly underweight the banks in that model portfolio for some time. Turning to another portfolio we run, the takeover target portfolio, where we try and select around 15 to 20 stocks that have a much higher than average likelihood of being taken over. October was a fantastic month for this portfolio, up around 5.6% in the month alone. One of the main reasons for that was GrainCorp. GrainCorp was one of our biggest holdings, and in fact it received a bid during the month from a US firm called Archer Daniels Midland. The bid was priced at $11.75 per share. I honestly think that ADM will have to pay up for GrainCorp. In fact, the board of GrainCorp has admitted as much. It said that it will reject the bid. It's inadequately priced, and I do think ADM will come back for a higher bid. We did take some profits in GrainCorp, but we bought back in at a lower price in expectation of that higher bid. And also Australian Infrastructure Fund, AIX, the Future Fund has bid for that. It's bid actually for the underlying assets the fund has. It's worth $3.22 a share. You don't get all your money for the best part of a year. And the market's actually had the shares trading below or at $3, which I think is a little bit cheap. There's a bit of a rumour going around that some other sovereign wealth funds might be having a look at Australian Infrastructure Fund. We think it's an excellent buy and also have that as one of our larger holdings in the takeover target portfolio for that very reason. And finally, our income fund. Now, this is where we hold really top 50 stocks, and we regularly write call options against the holdings for those clients that are in a position to have call options written against what they do. Now, again, over the past few months, stocks that pay strong dividends and have high dividend yields have been keenly sought after by investors. The banks, Telstra, even AMP and so forth, some of the property trusts, because as interest rates fall, then high fully franked dividend yields look increasingly attractive. And again, this portfolio does have a very heavy weighting towards the banks, to Telstra and so forth. There's no getting away from the fact that those sorts of companies are the big dividend payers in the Australian market. Having said that, as I mentioned earlier, the risks for the banks are increasing. I don't think their dividends are going down anytime soon, but as I said, the era of easy profit growth is probably well and truly past here in Australia. You know, consumers, despite the fact they're feeling better, don't want to borrow too much money. They don't want to have too much household debt. Those companies that are raising money are doing so via the bond market or the hybrid markets. They're not going directly to the banks. And in fact, NAB CEO Cameron Klein has admitted that the Australian banks have to broaden their funding base in any case, so that in the future, if overseas sources of funds drop away, they'll have alternatives to go to. Anyway, the fact is the income portfolio has been doing very, very, very well. Companies with sustainable, strong dividend yields will continue to be sought after in this environment of low interest rates, which we think will continue for some time. All right, we'll wrap it up there. Thanks very much for your company. This is the first in a series of these regular market updates from Beulah Capital, and I look forward to your company again very soon.